Risk management, in the context of finance, is the process of recognizing, analyzing, and accepting, or minimizing, uncertainty in investment decisions. Basically, risk management refers to the process by which a fund manager or investor assesses and makes an effort to quantify the possibility of losses in an investment, such as a moral hazard, and then decides what course of action, or inaction, to take in light of the fund's investment goals and risk tolerance. Risk in finance refers to the possibility that an investment will not produce the expected returns. The odds of losing some or all of your investment increase when you invest in riskier financial instruments. Bigger risk investments frequently have the potential to yield higher returns, while reducing the likelihood that you will lose your initial investment. For this reason, prior to investing, it's crucial to understand the many types of risk involved. Levels of investment risk. It's a good idea to invest in a variety of high, low, and medium risk assets, such as the following, if you want to diversify your portfolio. 1. Low risk investments. There are low-risk assets like cash to consider in addition to the largely risk-free options, like government bonds or gilts. Although buying cash and keeping it in a savings account carries no risk, the returns are smaller, and there is a chance that inflation will reduce the cash value. 2. Moderately risky investments. Corporate bonds are medium-risk investments. In essence, when you buy a corporate bond, you are lending money to a big company in return for fixed interest rates. Investing in gold and silver may be a good option if you're seeking a different medium-risk investment. Although gold prices vary, it is considered a safer investment than the stock market. Silver, on the other hand, carries a larger risk because it is more volatile than gold. 3. Investments with a high level of risk. Government bonds are believed to be low-risk investments, but high-yield or junk bonds are thought to be high-risk. These have a high default risk, which means there's a possibility you won't get your money back. Due to the stock market's infamously unpredictable nature, stocks and shares are considered high-risk investments. Although there is the promise of reward in emerging markets in some nations, they are more volatile than mature markets in countries like the UK. Cryptocurrencies are another example of a high-risk investment because of how quickly their value can change, making them very volatile. Additionally, the financial services compensation scheme does not apply to them. How should risk be managed? Every investment has some level of risk. These 3 investment techniques can assist you with risk management. 1. Diversification. With the goal of preventing a portfolio of lowly correlated assets from moving in the same direction at the same time, or at the very least, moving in the same direction to varying degrees. Diversification refers to spreading your investments across a variety of assets. Gains may be lost, but the overall risk of loss is less, and you will be better able to handle market ups and downs. For example, you could lose everything if you invest in only one company's shares in the event that it declares bankruptcy. However, by dividing your investments among 5 businesses, you run the risk of losing only 20% of your capital in the event that one goes out of business. 2. Correlation. Assets are said to be correlated if they move in the same direction. Combining assets that move arbitrarily or in opposite directions is one method of diversification. These assets can be thought of as negatively correlated or even uncorrelated. Because they are not affected by the same market movements, investing in assets that are not connected is advantageous. So, shocks in one market won't have an impact on the others. For example, the share price of a construction company and the cost of steel, which is used in construction, will both fall if the industry experiences a slump. These two have a great bond. However, since tech-related sectors won't be impacted, the share price of a tech business will fluctuate independently or arbitrarily because they are unrelated. 3. Determine your level of risk tolerance. Each person has the ability to tolerate risk while making market investments. When making investments, one must consider the level of risk they are willing to accept in light of their age, income, number of dependents, etc. Investors occasionally take on more risk than is necessary. Understanding your risk tolerance and the dangers in your investment portfolio can help you prevent emotional turmoil and protect your money in times of need. Avoid pursuing returns blindly. 4. Asset allocation. Your portfolio's asset allocation depends on a variety of personal criteria, including your age, risk tolerance, savings level, and financial objectives, even though it is mostly influenced by stock, debt, and cash. As a result, asset allocation is a complex process that takes into account not only equities and debt, but also your unique circumstances. An investment advisor might advise a 20-year-old differently than a 60-year-old when it comes to asset allocation. 5. Use the dollar cost averaging method to invest. It's challenging to forecast market conditions. It might be difficult to try to buy low and sell high, and most investors are unable to sustain any meaningful returns in this method. This strategy allows you to invest a set amount on a regular basis, whether the market is rising or falling. If you invest $5,000 every month, for instance, you might buy more shares when the market is down and fewer shares when it's up. A lower average cost per share would be the result of a long investment period. Please help support the channel by subscribing, liking and sharing our content. Go invest, grow and build.